Hi, I'm Justin, and welcome to the Landis Look, where we take an inside look at the world of real estate. And today I have a special guest with me, Mark Dacre. Mark, welcome.
Thanks. Glad to be here.
Mark is a mortgage lender with Ameris Bank, and Mark is the #1 lender in Georgia, has been for a while, and so it's a special treat to have him here today. And Mark is going to give us the inside look into interest rates, mortgage interest rates. And so since you're the #1 lender, you must have a crystal ball to know what interest rates you're going to do moving forward. Is that true?
There's no translation between how many loans I do and a crystal ball whatsoever. So yeah.
So you don't have to have a crystal ball to do a lot of loans, but you do know a lot about interest rates. And so I guess let's start with, we heard that the Fed recently reduced rates again. How does that tie, if at all, to mortgage interest rates? When we see that, what does that mean for our mortgages?
Yeah. The Fed certainly is an influencer of mortgage rates. They're not the controller of mortgage rates. So they kind of control this single rate where kind of how rates are being lent to banks, but they're not controlling mortgage interest rates. Mortgage interest rates are really dictated by a freely traded market. And so they're very interested in what the Fed's doing, but the Fed is not directly controlling those rates. So we've had instances where the Fed has dropped rates and mortgage rates have gone up in the past, and certainly vice versa.
So when we hear, hey, the Fed is likely to drop rates again, that is not a guarantee that mortgage rates are likely to drop.
Definitely not. In general, what they're looking for is the sentiment of the Fed. So they want to know, what's the Fed thinking the market looks like overall. On average, they're looking to get a sense of what inflation is looking like in the near future. So that's what the Fed is giving them some sort of indication on, and that's what their interest rate is generally indicating to the market.
So over the last year, rates have dropped quite a bit. If I remember correctly, I think last year at this time they were maybe around a point higher. What has led mortgage rates to drop so much over the last year?
Yeah, and that would be an example where the Fed has definitely had an influence on it. The Fed has been very bullish on saying, hey, we want to continue to stimulate the economy, drop interest rates, and they're giving the indication that they're not that fearful of inflation. So inflation is really one of the greatest movers and indicators of interest rates. And because the Fed has said, which is probably the most respected voice in interest rates, we're not that fearful of inflation at the moment. We're willing to continue to drop interest rates to stimulate the economy. The mortgage interest rate market has responded in like. So although it's not a guarantee, there is a general correlation. So they've been the biggest mover of interest rates, mortgage interest rates over the past year.
So what do you see moving forward? With mortgage interest rates moving forward, and I know you said you didn't have a crystal ball, but if I put you on the spot and made you have a crystal ball, what do you think is likely to happen over the next 6 months, year for mortgage interest rates?
Yeah. At the moment, there's not a really strong reason to believe they're going to go much higher based on the Fed's general commentary on them. On the same token, when they've reached the point they're at now, which has been in this mid-3 range, they generally have not found a way to go much lower. So they're pretty much at the bottom. Anytime they go really even a small amount lower than this, they tend to go back up pretty quickly. So
how far off the bottom are we right now?
From the very bottom that it kind of bounces off of, we're probably about 1/4 to 3/8 in rate. So we're really close to the bottom on average. And they've been trading around this same area for a little while. So since the Fed's not giving us any reason to believe they're going to start pushing their rates back up or to fear inflation, there's probably not a reason to believe mortgage rates are going to go back up. But on the same token, even if the Fed continued to drop their rate, it'd be surprising to see mortgage rates go much lower. So
this is a question I actually asked you a month ago. I have an investment property that I was considering refinancing and missed that absolute bottom of, what'd you just say, 1/4 or 3/8 or whatever. So for someone in that situation, should we try to wait and hit the absolute bottom? And how hard is that to do if you're thinking about refinancing or buying an investment property or something like that?
Yeah. Anytime you're trying to pick a bottom, it's extremely difficult to do. It's similar to picking the top of the stock market. Everyone would love to sell all their stocks at the very top and buy at the very bottom. Yeah. Mortgage rates trade in almost an identical way to the way that equity markets trade. So in reality, saving that extra 1/8, 1/4, 3/8 for most people probably is not a substantial difference in their actual monthly payment. So if the opportunity is there and it makes a lot of sense to refinance, I don't know that there'd be a hugely compelling reason to say I should hold out for the bottom, knowing that they're so close to the bottom anyway. On the same token, if it's not that compelling to refinance and you're like, hey, I would just love to do it if it gets to this point, and you already have a great rate, there's probably no harm in watching it. But it's not a game changer in terms of getting the quote-unquote bottom.
Yeah, I don't know if you remember what the number was, but something like getting that extra quarter point on a 15-year mortgage, I mean, it was only saving like a couple $1,000s over the entire life of the loan.
I think that loan was $12 a month or something, so that's not radically changing your life. So.
Yes, but those of you who know me and know how frugal I am waiting to try to hit that absolute bottom.
You want to go for it.
Because that's how I like to do things. So when we think about this from the homeowner's standpoint, though, there is a big difference between a point, right? I mean, if you were looking at last year at this time buying or this year at this time buying, how much does that correspond to? And is there some sort of like, hey, a point equates to something in the purchase price that people could use as a kind of rule of thumb for rates?
Yeah. So, I mean, really, it's relative to your loan amount. So this is all a percentage of something. So, and really, it's just as you would think of percentages. So 1 point on $100,000 is $1,000. So you're talking about somewhere in the neighborhood of $83, $85 a month or something like that per 100,000. That will amortize down over time as you pay principal. That interest will begin to decrease. Yeah. But that is notable. I mean, if you have a $400,000 loan, you're talking about a few $100s a month that you're now saving by saving that point in rate. Certainly over the lifespan of the loan, that's substantial.
That is substantial. Yeah. Anything else around interest rates that we need to be concerned or worried about or anything like that? Or do you feel like, hey, because they have been stable for a while, I mean, feel like, hey, we're in a pretty stable environment right now?
Outside of some substantial changes either in the economy, and the biggest economic changes that mortgage rates and interest rates in general most closely pay attention to are any sort of major changes in inflation or the employment market. Yep. So as long as we see stability there, we'll probably continue to see stability in the interest rate market for the most part. Also, it's been cyclically true for a little while that generally before election cycles. I was
going to ask you that.
Yeah, it doesn't matter, Democrat or Republican. In general, mortgage rates don't change a whole lot going into those periods just because, or if anything, they tend to drop a little bit. You tend to see a little bit more Fed leniency to keep a healthy economy healthy. Yep. There's a motivation there, of course, politically to keep the economy looking healthy. And so I would say all those things added up probably over the next 6 to 12 months wouldn't give us any great reason to believe rates will go up substantially. But again, even if there's a great deal of economic leniency, the Fed was to drop rates even more and be as aggressive as they possibly could. While that is good for other things like student loan rates, car loan rates, credit card rates, all those things tend to be more directly impacted by the Fed's interest rate. It would be somewhat surprising to see mortgage rates go down too much farther, even if the government and the Fed were extremely aggressive on interest rates.
So if I'm hearing you correctly, I mean, rates are at a low point near the absolute bottom that they have ever been. And even if things do trend down for other rates, we're probably unlikely to go much below that bottom, even in the craziest of situations. Yeah. And there's not a lot moving right now in the economy heading into election year with good unemployment, with low inflation that you think is likely to drive it in any really strong direction in the short term.
Yeah. It would take something surprising that's not currently in existence, I think, to see much otherwise.
Awesome. Yeah. Well, thanks for the education on rates today, Mark. So good news for all of us out there. Interest rates are low. So if you do have a high interest rate and you want to refi, now's a great time to do it. If you are thinking of buying either an investment property or a personal residence, interest rates are low. So all that's positive. And we appreciate Mark's time today. Thanks for coming, Mark.
My pleasure.
All right. See you next week.